The stock market is valued at over $120 trillion, and it touches almost every aspect of your life, from the phone that's in your pocket, to the coffee that you're drinking, to your retirement accounts. But for most people, the way that it works is a mystery. My name's Oleg, I'm an accountant, and in this video, I'll cover how the stock market works from the ground up. So let's start at the very beginning. Let's say that you run a small coffee shop that sells the best coffee in town. But you have an even bigger vision, and you want your coffee shop to be on the corner of every street across the country. The problem is that building out the new shops, buying new equipment, and hiring staff, that's all going to cost money, way more than you have sitting in your checking account. So what are your options? Well, first you can go to your family and friends and ask for some help, but that can only go so far. Your second option is to go to a bank and ask for a loan. But if you do get the loan, you'll be on the hook for paying it off, regardless of whether your business is doing well or whether it's doing poorly. Your third option is to issue stock. A stock is simply a piece of ownership in a business. So when a company issues stock, it's selling an ownership stake in its business to outside investors. Shares are how ownership gets measured. So if Coffee Co. has 1,000 shares in total and I buy 100 of them, I now own 10% of the company. In the real world, companies issue millions of shares, but the idea is the same. So when a business issues stock, it gets the cash that it needs to expand and grow without having to repay that cash in the future. In return, the investors who buy that stock get to participate in the business's future growth and profits if it does well. The downside to you is that you're no longer the sole owner of the business. And to the investors who bought in, there's always the risk that the business doesn't perform as well as expected, and their shares could drop in value. So that's the basic idea behind issuing stock. And that's how companies like Uber and Facebook got the cash they needed to grow into the giants that they are today. Alright, so that's what a stock is. Now when people talk about the stock market, they're talking about this entire system where shares of companies are being bought and sold. So think of it as one big auction that matches the people who are looking to buy shares with the people who are looking to sell their shares. But the actual trading itself happens on stock exchanges. So in the US, the two biggest exchanges are the New York Stock Exchange and the NASDAQ. The New York Stock Exchange has been around for over 200 years and it still has a physical trading floor, even though most of the trading nowadays is done electronically. Household names like JP Morgan, Walmart, Exxon, Visa, they all trade on here. The NASDAQ is a more recent exchange, and that one's fully electronic. And it's the go-to home for mostly tech companies like Apple, Microsoft, and Tesla. At the end of the day, it's up to the company itself to decide which exchange it'll list its shares on. But to a regular investor, it makes basically no difference whether you're buying from the New York Stock Exchange or the NASDAQ. And of course, these exchanges, they're not just an American thing. London, Tokyo, Shanghai, those are just a few of the other major stock exchanges from across the world. Let's go back to our coffee company. The very first time it sells its shares to the public is called an initial public offering, an IPO. That's the company's big debut. It means that for the first time, everyday investors can now buy into the company. And the money that's raised during this IPO goes to the company's bank account. The cash is what pays for the new stores, more staff, new products, or whatever else the next big step in its future may look like. But once those shares are out in the market, then they trade between investors, and the company doesn't get any more money from those secondary trades. And that's what people usually mean when they're talking about the stock market. So they're referring to this massive secondary market where shares trade hands between other investors. But if the majority of the market is just investors buying and selling for one another, then who's responsible for setting the prices of stocks? The short answer is that nobody's in charge, and prices come down to basic supply and demand. So if more people want in on the stock than are willing to sell it, then its price is going to go up. But if the opposite is true and more people want out of that stock, then its price is going to fall. But here's the thing. Why people want to buy and sell can come from very different places. In the short run, it's a mix between emotions and expectations of where the market's going. The market reacts to headlines, quarterly earnings, scandals, hype, fear, and optimism. And that's why you can see wild swings in the stock's price, even when the actual business could still be operating like normal. But over the long run, it's the business fundamentals that start to matter more. So that's things like its revenues, profits, and debt levels. And over time, the stock price tends to reflect how the business itself is actually performing. And if all that wasn't enough, then you also have the big outside forces that are pulling at prices. So think interest rates, inflation, geopolitics, and the state of the overall economy. And these are forces that don't just impact a single stock, but they impact what the entire market is doing. So when people scratch their heads wondering why a stock's price looks the way that it does, It's because there's all these different variables impacting what buyers and sellers are doing. Now, if we zoom out, we can see that there's literally thousands of companies that are trading every single day. Some of them are going up, some are going down. So we need a simple way of looking at what the overall market is doing. And that's where indexes come in. Think of them as scorecards for the market. So instead of tracking what individual companies are doing one by one, an index bundles a group of stocks together and then spits out a single aggregate number that you can keep track of. The two most popular indexes in the US are the Dow Jones and the S&P 500. The Dow Jones tracks 30 of the largest US companies that are leaders in their industries. So think Apple, Coca-Cola, and McDonald's. Most of these companies are household names that people are familiar with. The S&P 500 is a more in-depth index, and it covers the 500 biggest public companies in the US. And because it looks at more companies, it ends up being a more representative sample of how the market as a whole has been performing. So when you see headlines like the S&P 500 is up 1% for the day, that's just a simple way of saying that on average, the biggest US companies made gains as a group. But these day-to-day swings, they don't tell the full story. And what matters more is the big cycles that the market goes through and which one we're in right now. A bull market is the good times. Businesses are growing, investors feel confident, and stock prices are climbing. We're technically in a bull market when prices rise 20% or more from their recent lows. On average, they last about 4 years, but the bull market from 2009 to 2020 lasted nearly 11 years. During that stretch of time, the S&P 500 went up 400%. But what goes up must come down, and when things take a turn for the worse, we enter a bear market. This time, it's when stocks drop 20% or more from their recent highs. And this is a period when the economy slows down and profits shrink. Investors lose confidence in the market, they start selling, and that selling snowballs until the market finally bottoms out. Now, every so often, the market completely goes off the rails and forms a bubble. That's when stock prices climb way higher than the underlying companies are actually worth. And people keep buying into this market because there's this euphoria that these prices will keep going up forever. And at the end of the day, no one wants to miss out on the action. But eventually, the party ends, the bubble bursts, panic spreads, and prices collapse. We find ourselves in a market crash. That's what happened in the dot-com crash of 2000 and the housing crisis in 2008. The important thing to understand is where a market is at a given point in time, because you don't want to be caught blind by fear, greed, or euphoria, and you want to invest accordingly. And remember, no market and no bubble lasts forever. Now, who are the other players in the market that you're buying and selling from? Broadly speaking, there's two types of investors. On one side, you have your retail investors. These are everyday people who are investing their own money. And they could be buying individual companies or investing in the long term in their retirement through accounts like their 401ks and their IRAs. And these trades matter, but when you zoom out and look at the big picture, there's small potatoes to the second group, the institutional investors. These are the giant organizations that manage money for millions of people. So think mutual funds, pension funds, hedge funds, insurance companies, college endowments, even sovereign wealth funds that are run by governments. So when these massive institutions decide to buy or sell, they could be moving millions, if not billions of dollars at a time. And that could send shockwaves throughout the entire market. So how do people make money with stocks? For regular investors, it comes down to two main ways. First, you can make money when the price of your stocks go up. And these are called capital gains. So if you buy a stock for $100 and you sell it at the end of the year for $120, that $20 profit that you pocket, that's your capital gain. The bulk of stock market wealth came from these capital gains. So companies do well, their earnings rise, and their stock prices, they follow. The second way is through dividends. So some companies choose not to reinvest all their profits back into the business and instead distribute them out to their shareholders as regular payouts. Dividends are common with the large established companies, and even if their stock price doesn't move all that much, all of these dividend payments can really add up to be a serious return on your investment. So why do people put their money in the stock market? It's because if you zoom out, the market tends to go up. Over the last 100 years, we've had everything thrown at it. Wars, recessions, inflation, oil shocks, political chaos, you name it. And yet through all of that, the long-term chart still slopes upward. Never in a straight line, but it does go up and to the right. Now that doesn't mean that the future is going to look anything like the past. Nothing in investing is ever certain. But this long-term consistent growth is enough for people to put their trust in the markets and entire retirement systems. So people's 401ks, IRAs, pensions, they're all built on the assumption that stocks are going to be worth more decades from now than they are today. There's also this thing called the wealth effect. So when the stock market goes up, people see their portfolios raise in value and they start to feel richer and they start spending more. That spending flows back to the same companies that are listed on the market, which boosts their profits and leads to their stock prices going even higher. It's this loop that keeps the stock market engine turning. And that's the real reason why people invest, because history shows that growth, innovation, and human progress pushes the market up higher over the long haul. So guys, that's how the stock market works. I hope this video helped. If it did, I'd love to see you drop a like and subscribe to help support the channel, and I'll see you on the next one. Bye-bye.